I'm pleased to say that joining us is an excellent guest. It is Blair Jacobson, Co-President of Ares Asset Management. Blair, thank you so much for joining this morning.
Great to be here, Dani.
Fantastic to see you in Berlin. And look, it's been half a year that's, let's be honest, has felt like a decade. It's also half a year in which you were elevated to co-president, so you have a more holistic view of the business. In this moment of volatility, just how challenged are corporate business models for funding and liquidity right now?
So we're clearly in an interesting moment. We came into this very, very well positioned. You know, our company's book is roughly 70% credit, 90% of that senior secured. Earnings did very well in 24 and into Q1 25. Clearly, this is the year where we see the results of politics, a lot of twists and turns, but when we think about how the businesses are performing, we're more focused on the mid-market, so our company's a little bit more local focused and international trade focused. They're also in sectors which tend to be a bit more resilient, less manufacturing, a bit more services. But we're still getting the numbers in for April and May, and we'll see, but so far we haven't seen any real negative KPIs or liquidity signals that would lead us to be overly concerned around business activity.
Is there anywhere that there's stress? I mean, there's got to be, right? Things are so upended. You feel it certainly in public markets. Is that nowhere in private markets?
I think what does make us nervous, what we're monitoring very, very closely, are the derivative effects. Even if you don't have tariff-impacted businesses, certainly, you know, all of the dislocation in the markets would make a CEO hesitant around new business decisions, CapEx decisions, growth decisions. So we're very focused on CEO confidence. It also goes into consumer confidence. Consumer, big force in the economy, thinking about how they're allocating their spending, especially because it's very discretionary. So I'd say those are the two areas that we're really focused on from a risk perspective.
And any signs of any stress there yet?
Not yet, but we're monitoring it very carefully.
Well, elsewhere, there has been deal volumes that have really started to plummet. M&A is on the back burner at this moment. Banks are also still competing at a moment where private credit has raised a lot of capital. Ares itself, a lot of dry powder. You mentioned 70% credit. Does that mean that more money is chasing fewer deals? Is that a problem for this industry right now?
Good question. I feel like this comes up every couple of years. You're right, we feel great. We have $140 billion of dry powder, record for the firm, and the question is, how would we invest that? If you go micro, look at Europe, we talk to something like 1,400 companies every year. We only make new loans to between 30 and 50 companies. So again, we're very selective. There's a lot more going on in the markets. Also, if you look at the dry powder of private equity versus credit, credit's maybe 15 to 25% of that. So again, as long as there's confidence, in particular in the mid-market, private equity needs exits, their LPs need DPI. So even though things have slowed a little bit, still active on the M&A side, but also very active on the refinancing side and the industry consolidation.
Do you think others are being less selective, though, with all that money that needs to be put to work?
I'd say potentially. You know, again, we don't comment on what our competitors do every day. I think we're more focused on what we're doing. And again, this is a market where due diligence, credit discipline, documentation discipline is especially important.
Very diplomatically answered, Blair. I appreciate that. But within this era of competition, the banks are still big players. In fact, we see a lot of deals where borrowers are trending more towards banks in prior periods of dislocation when private credit was really their only option. Has that surprised you?
Not really. I think that private credit, the foundation has always been in the mid-market where commercial banks are less active. When you think about bigger companies, they've always accessed the capital markets. It's very efficient. I think the interesting thing today is when you see what happened in 2022 and 23, when the capital markets were closed for a long time, private credit came in and financed a lot of these businesses. So companies and their owners now know that they have options. This is really advantageous for us. Bloomberg reported on a really big loan we just signed in the US. We're working on similarly sized loans here in Europe that are big and companies that could access the capital markets, but at the same time find private capital more compelling.
Well, the other big change that maybe is starting to be underway for this industry is the so-called convergence of public and private. And part of the way that's taking shape, Apollo, our reporting suggests that they're opening up a trading desk, trying to get more liquidity into the asset class. But this is an asset class that one of its benefits had been low volatility. So is it an issue if it starts to trade more and there's more mark-to-market and more volatility?
So I think our view on that is public-private convergence is happening. We first saw that in the loan space, again, as I just mentioned, with larger companies. The next question that's been brought up is, will private credit ever trade? I think we take a bit of a skeptical view on that. Private loans are private for a reason. Their owners want it private for a reason. They tend to be smaller companies, more concentrated holdings. And in fact, in some of those documentation provisions, you're actually prohibited in some ways from trading. So might things move around a little bit? Perhaps more stress names potentially, but does it become big? I think we have to wait and see on that.
So just structurally, the mechanism isn't there, from what I'm understanding, to get more widely traded.
It's a challenge.
Okay, it's a challenge, but part of the reason, presumably, funds like Apollo are trying to do this, is because they want the liquidity to package up into more retail-type wealth management products. I know it's something Ares has been very active in, wealth management, but if the industry as a whole is pushing to retail, the criticism is they're packaging up the worst stuff and selling it off to retail. Is that a real risk?
I think for us, retail's been part of our DNA for 20 years. Started really with our first loan vehicle in the US, which is a publicly traded BDC, which has gone through all types of different macro environments, micro environments. When we think about the loans that go into those vehicles, it's the exact same loans that our institutional clients get. That's how we allocate them. So again, I don't view that at all as a negative.
We have seen some of your peers team up with more retail-type companies. So you have KKR and Capital Group, Blackstone with Vanguard and Wellington. Would Ares ever do one of these partnerships?
We're always exploring those partnerships. Certainly from our perspective, again, around a quarter of what the firm does touches retail in some way, shape, or form. That's not only in publicly traded vehicles, increasingly that's on the wealth side. I think with any partnership, you have to explore the benefits for both sides. I say currently we're doing fine with what we have, but we're always looking at additional opportunities.
What's sort of the precipice in when you say, okay, we need to bring a partner on, that we don't want to just go at this alone? What is that line in the sand?
I think what we always are mindful of is accessing different distribution channels that perhaps would be a challenge for ourselves and our existing team. We're obviously very mindful that a lot of these companies, for example, there's discussion in the US about allowing 401ks to invest in private markets more, and some of those businesses that you mentioned have very good lines of sight into those clients. That's something we're monitoring closely as well.
It's interesting because in some ways hedge funds underwent this stress. When all of a sudden ETFs became really popular, one of the things it did was it brought fees down, because all of a sudden you're competing with these retail products that have lower fees. Could that possibly be the destination for this industry? Could fee models be challenged if all of a sudden you have cheaper retail products out there?
So I think the way we think about it is, broadly speaking, the fee model needs to match the risk-adjusted return of the underlying asset. In particular, private assets are hard to originate. We have hundreds of people all over the world seeking unique assets for our clients, and again, that demonstrates a certain fee level that our institutional clients pay and our retail clients pay. Do people always want to pay less for more? Of course they do, but again, we think that that's under a good trajectory.
Well, it's part of the hard work you do, and why we're so pleased to have you now as co-president of Ares. Blair, thank you so much for joining. We really, really appreciate your time.
Dani.
I know there's limited amount at this conference, so you're very generous. Vonnie, with that, I'll hand it back to you. That is, of course, Blair Jacobson of Ares.